At first, it sounded terrifying. A quiet headline passed around trading forums, group chats, and late-night finance videos. Switzerland froze silver. For anyone holding precious metals, or even just trying to protect their savings from inflation, the implication was clear. If a neutral, stable country like Switzerland could suddenly lock down silver, then nowhere was truly safe. It played directly into a growing fear many people already feel but rarely articulate, the sense that the financial system can change the rules overnight. But here's the uncomfortable truth. Switzerland did not freeze silver. No vault doors slammed shut, no global ban was quietly imposed. The story, as dramatic as it sounded, was false. And yet, focusing only on whether the claim was fake misses something far more important. Because while the event didn't happen, the risk behind the fear is very real. It just doesn't look the way most people expect. Imagine a middle-income family in the suburbs of Toronto. Both parents work. The mortgage rate reset last year at a much higher level. Groceries cost more than they did even 6 months ago. Their savings account earns less than inflation, and their retirement feels increasingly abstract. They don't think of themselves as investors. They just want stability. Somewhere along the way, they hear that silver is real money, that it's protection against inflation, that it's tangible, and then they hear that Switzerland froze it. What they're really responding to isn't silver, it's fear. Fear that the systems they rely on, banks, markets, governments, are more fragile than advertised. This is where most people misunderstand what actually matters. The idea of a country freezing silver sounds like a dramatic act of confiscation. It evokes memories of gold seizures in the 20th century or capital controls during financial crises. But modern financial power rarely works through blunt force. It works through choke points, quiet ones, administrative ones. Boring ones that don't make headlines until it's too late. To understand this, you have to zoom out and stop thinking in terms of assets alone. Silver, gold, stocks, crypto, these are all downstream. The real system sits above them. Clearinghouses, custodians, vault operators, refiners, transport insurers, settlement networks. The pipes that allow assets to move, be verified, be delivered, and be recognized as legitimate. Switzerland matters in this story not because it can freeze silver, but because it sits at the center of something far more subtle. It is one of the world's most important hubs for precious metals, refining, and logistics. A significant share of the world's newly refined silver passes through Swiss refineries before it ever reaches investors, industrial users, or national reserves. This doesn't mean Switzerland controls silver. It means that silver, at a critical stage of its life cycle, depends on Swiss infrastructure. That dependency is the real risk. Consider how most people think about ownership. If you buy silver through a brokerage account in London or New York, you see a number on a screen. If you buy physical silver stored in a vault, you're told it's allocated, segregated, safe. But ownership in modern finance is layered: legal ownership, beneficial ownership, custodial ownership, operational control. These layers usually align until stress enters the system. During normal times, no one questions whether they can sell, move, or take delivery of what they own. But history shows that during periods of strained currency instability, sanctions, trade disruptions, or sudden regulatory shifts, access matters more than ownership. This is why the Switzerland rumor spread so quickly. People instinctively understand that the risk isn't theft. It's immobility. The same dynamic already exists in everyday life. A worker in Manchester may technically earn more than they did 5 years ago, but their purchasing power is lower. A family in Sydney may own a home on paper, but feel poorer each year as insurance, taxes, and interest payments rise. In the U.S., millions contribute to retirement accounts they can't touch for decades, trusting that the rules will remain stable. Most of the time, they do. Until they don't. What makes Chokepoint risk so dangerous is that it doesn't require bad intentions. It can emerge from compliance rules, sanctions regimes, environmental regulations, or emergency measures introduced during crises. Each change makes sense in isolation. Together, they narrow the pathways through which assets flow. In the silver market, this could look like stricter export controls on refined metals, enhanced reporting requirements for vault operators, insurance exclusions for cross-border transport, or settlement delays at clearing institutions. None of these are dramatic freezes. And yet, if enough of them align, liquidity disappears exactly when people need it most. This is where the misunderstanding deepens. Many people believe risk only exists when something dramatic happens, a ban, a seizure, a collapse. But in modern finance, risk often accumulates invisibly through friction, through delays, through temporary measures that quietly become permanent. Meanwhile, the narrative stays focused on the wrong question. Did Switzerland freeze silver or not? That question is comforting because it has a yes or no answer. The real question does not. How concentrated is the infrastructure behind the assets people use to protect themselves? How many steps exist between ownership and access? And how resilient are those steps under pressure? For decades, globalization optimized for efficiency. Supply chains became lean. Financial systems centralized around trusted hubs. Switzerland earned its reputation precisely because it was stable, neutral, and reliable. But concentration and reliability are two sides of the same coin. When too much flows through too few places, stability becomes a single point of failure. The irony is that many people turn to silver because they distrust paper systems. Yet the modern silver market is deeply embedded in those same systems. Paper claims on physical metal, ETFs that promise exposure without delivery, vault receipts that depend on third-party verification. Even physical bars rely on refineries, transport networks, and legal frameworks to be recognized and tradable. None of this means silver is useless. It means the story is more complex than most people are told. As inflation quietly erodes savings across the US, UK, Canada, and Australia, people are searching for anchors. Something solid, something outside the system. The Switzerland rumor resonated because it suggested that even the anchors might be chained to the same dock. And here's the part that rarely gets discussed. If a choke point ever does tighten, it won't announce itself as a freeze. It will feel like inconvenience. A delay in delivery, a sudden premium, a rule change buried in paperwork. By the time it's obvious, the flexibility is already gone. When choke points tighten, they rarely feel like emergencies at first. They feel like paperwork. An email from a custodian explaining a delay. A notice about temporary compliance adjustments. A broker informing clients that physical delivery will take longer than expected, or that certain jurisdictions now require additional verification. Individually, none of these moments trigger panic. Collectively, they change behavior. This is how access risk becomes real. The consequences don't arrive as a dramatic collapse. They arrive as a narrowing of options. People discover that selling is possible, but only at a discount. Moving assets across borders is allowed, but only after weeks of review. Taking delivery is permitted, but insurance costs have doubled or transport routes have quietly vanished. The asset still exists. Ownership still exists. What disappears is flexibility. For a middle-class household in the United States, this mirrors something they already understand. A 401k balance might look healthy on paper, yet accessing it early comes with penalties and tax consequences. A homeowner may be equity-rich, but refinancing during a credit tightening suddenly becomes impossible. A Canadian saver might hold assets denominated in strong currencies, yet face limits when trying to move funds internationally during periods of heightened scrutiny. These aren't failures of the system. They are features of a system designed to prioritize stability over individual convenience during stress. The problem is that most people only plan for asset risk, not access risk. They diversify what they own, but not how they access it. Stocks versus bonds, cash versus metals, domestic versus international. What's often ignored is the infrastructure layer, who holds it, where it clears, under which legal framework, and through how many intermediaries. This is where smarter adaptation begins, not with panic buying or dramatic exits, but with quiet restructuring. Some individuals start by asking simple questions they never needed to ask before. If I needed liquidity during a market disruption, how quickly could I actually get it? If a border closed temporarily or regulations shifted, what assets would remain usable in my daily life? If digital systems experienced outages or restrictions, what still functions? In Australia, this has led some households to rebalance toward a mix of assets that serve different purposes. Liquid cash for short-term shocks. Productive assets like businesses or skills that generate income regardless of market conditions. Long-term stores of value that aren't relied upon for immediate expenses. The key insight isn't distrust, it's role clarity. Assets are tools. Problems arise when a tool is expected to do a job it's not designed for. Silver, for example, is not a checking account. It's not meant to cover monthly bills or emergency expenses. Its role, historically, has been preservation over long periods, particularly during currency instability. When people expect instant liquidity from long-term hedges, frustration is inevitable. This reframing reduces fear. Once you stop expecting one asset to solve every problem, chokepoint risk becomes manageable rather than paralyzing. Another adaptation is decentralization, not ideological, but practical. Not all assets held in one institution. Not all exposure tied to one jurisdiction. Not all access dependent on one system. This doesn't mean hiding or evasion. It means redundancy, the same way critical systems in aviation or healthcare are designed. The financial system already does this at the highest levels. Central banks hold reserves across multiple locations. Corporations maintain banking relationships in more than one country. Governments diversify supply chains after disruptions. Individuals are simply slower to adopt the same mindset because, for decades, they didn't need to. But the world has changed. Inflation has reminded people that purchasing power is not guaranteed. Geopolitical tension has reintroduced sanctions and trade barriers as routine tools. Digital finance has increased efficiency, but also centralized control. None of this signals imminent collapse. It signals a shift from abundance to constraint. In constrained systems, access is power. Those who adapt early don't do so loudly. They don't chase every alarming headline. They study where dependencies cluster and where alternatives exist. They pay attention to legal structures, not just market prices. They value boring resilience over exciting returns. This is especially visible among older households who lived through multiple cycles. In the UK, some remember when mortgage rates reached double digits. In the US, others remember bank failures and savings and loan crises. In Canada and Australia, property booms taught hard lessons about leverage. Experience teaches that the most dangerous risks are the ones that feel impossible, until they aren't. What's striking is how rarely these adaptations are framed as financial strategy. They look like lifestyle choices. Keeping expenses manageable, maintaining employable skills, avoiding excessive leverage, holding some assets for utility, not yield. These choices don't show up as dramatic portfolio moves, but they quietly reduce dependence on fragile pathways. And this is the deeper truth behind the Switzerland silver rumor. The fear wasn't about silver, it was about control. About who ultimately decides what you can access, when, and under what conditions. People sense that those decisions are increasingly distant from their daily lives, made by systems optimized for stability at scale rather than individual needs. That discomfort isn't irrational, it's a signal. But responding to it with misinformation or dramatic narratives only makes people more vulnerable. It pushes them toward false certainty, toward thinking that one asset, one country, or one strategy can eliminate risk entirely. It can't. Resilience comes from accepting complexity rather than denying it. The financial world is not moving toward a single catastrophic event. It's moving toward a series of small frictions that reshape behavior over time. Access becomes conditional, liquidity becomes situational, trust becomes layered. Those who understand this stop asking whether something will be frozen and start asking under what conditions it remains usable. That shift in perspective changes everything. It turns fear into planning, rumors into research, assets into tools rather than talismans. And it replaces the search for absolute safety with something far more realistic, adaptability. Because in the end, the real chokepoint risk isn't Switzerland or silver or any single node in the system. It's the assumption that tomorrow will function exactly like yesterday. History suggests it never does.